Okay, in this video we're going to summarise the impacts of the financial crisis and the causes and talk about how they actually impacted share prices. So first of all, when you're summaring up what happened, so basically in really simple terms, the banks lent way too much money to people that were too risky of borrowers and couldn't afford to pay back their loans. So the increase in borrowing, because everyone was allowed to basically purchase a house that wanted one. House prices went up and up and up at really fast levels for a long period of time. So demand for housing went up because it was so easy to get a loan. So basically for this long period of time there was lots and lots of demand for housing because they were letting anybody buy a house that wanted one basically. Then eventually many of these borrowers started to default on their loans. So a lot of people realised they couldn't pay the interest anymore, and therefore they had to default on their homes, and all these homes started to get sold in America in around 2008. This led to a massive increase in the supply of housing. All these houses were getting sold, and because there were so many houses on offer and not enough people that wanted to buy them, prices started to go down really quickly. And that meant that people had mortgages of like 500, 600, 700,000, but the actual value of their houses was worth much less than that. So their mortgage was higher than the value of their house. They had negative equity in their houses. Then basically, because the banks realised so many people were defaulting and they were getting stuck with these bad loans and they were getting stuck with all these money that people owed, and they were defaulting on their houses, the banks started to stop lending money. So the banks stopped lending people money. Lots of people lost lots and lots of wealth on their homes, and they stopped giving out things like credit card loans and home loans for people. So therefore, basically, the demand for property fell as well. So because not only was there this increase in supply, it was also now harder to get a loan. So there was less demand for property as well. So basically, and then what happened with the banks is the banks lost millions of dollars because they had lent lots and lots of money to all these lenders that couldn't pay it back. So these lenders had to declare bankruptcy because they realised they wouldn't be able to pay back their loans. And the banks got stuck with these houses now that weren't worth as much. So like, for example, if I took out a mortgage worth $1 million for a house, then they realised I couldn't pay it back, I would still owe the bank $1 million. I say to the bank, I can't afford that. So they say that's bad, but then they get my house. So then they try and sell my house, but now they can only get $500,000 for my house. So the banks get stuck with this $1 million worth of somebody else's loan that they couldn't pay back, but they've only got a house worth $500,000. So the banks lost millions of dollars because they now had these properties that they now owned because people defaulted, but it was much less than the amount they had lent these people in the first place. So basically what happened in America, as house prices fell, citizens experienced a large decrease in their wealth. Many citizens became homeless because they couldn't afford to make their repayments. And even those who could afford to make their repayments now had houses that were not worth nearly as much as they had been in the past. So the decrease in citizens' wealth led to a large drop in spending across the economy. People didn't spend as much because they were no longer as wealthy. Their houses weren't worth as much, or they had lost their house. And because the banks were also becoming more reluctant to lend people money because they were fearful of people not paying back. So all this basically across America, spending started to decline. People had less money, people had lost their houses, the banks were making it hard for people to borrow money. So as spending started to fall, businesses that sold products experienced a large decrease in their profits. So the decrease in spending then meant that firms experienced a large decrease in their profits. And as companies' profits continued to fall, companies' share prices started to fall. And this is when it started to impact people all around the world. So people lost a lot of wealth, they had less money, and then they stopped spending. Spending started to slow down in America. And as spending started to slow down in America, companies sold less products and companies' share prices started to fall and the share market crashed. So many Americans who had invested in these shares lost millions and millions of dollars as the share market started to fall. Many retirees had their superannuation tied up in the share market, so they had put their money that they had earned while they had a job in the share market. They started to lose lots of money as well. So grandparents had to start moving back in with their parents, with their children, because they had lost lots and lots of money in the share market. Other nations, including Australia, were also affected. So as the United States became poorer, they didn't demand as many of our exports, so we weren't able to sell them as America as many products as we used to in the past. This led to a lot of job losses in industries like tourism in Australia, in manufacturing, all these places where we were trying to sell things to overseas. They lost lots of profits as well and sold less products. So the share prices of many Australian companies fell because they couldn't sell as much to America because Americans didn't have as much money anymore. So the share prices that people had invested in, like Rio Tinto and BHP or Woolworths or Coles, all of their share prices started to fall as well. And not only that, many Australians also invest in this US share market. So many Australians had invested in the US share market, and therefore they had lost lots of millions of dollars on their superannuation. So their super wasn't worth as much because it was tied up in all these American companies, all these Australian companies, and therefore they lost hundreds of thousands of dollars. So as people became less rich in Australia, spending and growth and production in Australia started to slow down as well. So to sum up, just really, really quickly, American house prices in America fell. People in America lost lots and lots of money. They stopped spending. Their spending in America started to fall. As spending in America fell, companies' profits started to fall. Companies were making a lot less money. So share prices in America started to fall. So all these people that had invested in shares, whether it was Australians or Americans, lost hundreds and hundreds of thousands of dollars because the share market was now not growing as fast. This reduced the amount of jobs because people weren't spending as much all around the world, and countries started to grow much, much slower.